Google shares tanked 7% in pre-market trading on Wednesday following a fourth quarter revenue miss. The culprit? Softer than expected sales in cloud services, similar to rival Microsoft's latest earnings, and a deceleration in the business from the preceding quarter. Google reported better than expected EPS, but missed on the top line for its fourth fiscal quarter on Tuesday. Google generated $2.15 per share in adjusted profits on revenues of $96.5 billion. Therefore, the online advertising giant beat the consensus bottom line estimate by $0.02 per share, but missed the consensus top line expectation by $200 million. Google generated $96.5 billion in revenue in the fourth fiscal quarter, showing 12% year-over-year growth, but also a 3 pp revenue growth deceleration compared to the third quarter. Search delivered steady growth, and the company reported $54 billion in revenue, showing 13% year-over-year growth amid a strong spending season in digital advertising. The fourth quarter typically is a good one for digital marketing platforms as advertisers spend a lot of money in order to take advantage of the holiday period. Google generated $72.5 billion in total advertising revenue, which includes YouTube, ads showing 11% year-over-year growth, while cloud, the fastest growing business within Google's portfolio, generated 30% year-over-year segment top-line growth and total revenue of $12 billion, the highest amount in the company's history. Importantly, Google saw very strong growth in its operating income, which was once again driven by Google Cloud. Total operating income was $31 billion, plus 31% year-over-year, which put the company on about $125 billion annual operating income run rate, the majority of which came from services. Cloud generated $2.1 billion in operating income for Google in Q4 24/20, showing 142% year-over-year growth and representing an operating income share of 6.8%. With cloud expanding rapidly amid strong demand for cloud infrastructure, I believe this business will continue to deliver excellent results for Google going forward. Google remained a free cash flow cow in the fourth fiscal quarter as well, earning $12.8 billion in FCF, showing about 215% growth compared to the year earlier period. Despite heavy AI investments, Google's free cash flow margin in Q4 24 was 25.7% compared to 20% in Q3 24 and 9.1% in Q4 23. So the company is seeing some healthy FCF margin expansion here as well. With so much free cash flow streaming into the bank accounts of Google and with cloud's operating profitability soaring, I believe Google could be ripe to announce a major increase in its stock buybacks authorization in the next several quarters. Currently, Google is eating away at its $70 billion stock buyback program, which was announced last year. In Q4 24, Google completed stock buybacks of $15.6 billion, which lifted full-year buybacks to $62.2 billion. A new stock buyback in the amount of $70 billion or higher would be a great way to provide new support for the company's shares. The most important takeaway for investors, in my opinion, was that Google continues to expect to spend a lot of money on AI. Artificial intelligence spending has surged after the appearance of ChatGPT and other AI models. To run and train LLMs, companies need to invest a large amount of money into expensive GPUs, which is what has been driving capital spending in the big tech group in the last 2 years. Google's heavy AI spending as well as top-line miss caused a share price drop of 7% on Tuesday, which I believe investors should take advantage of. If you liked this video, subscribe to the channel for more, and if you don't want to miss anything, hit the bell. With that being said, see you in the next one.